Say what? Jiminy Cricket. No way, Jose. Have you ever seen crazy headlines and wondered if they were clickbait or they were real? Are you lazy like most people and you just read the headline, assume it's real, and let it affect your emotions? Do you wonder what news you can trust and what you can't? Well, on today's episode of Mortgage Monday, I'm going to be reading just the headline of popular mortgage-related articles and trying to debunk if they are true or not and what they actually might mean. So pay attention, you just might learn something, and maybe it'll help you fight your way through the clickbait and get to the truth of what's going on in the real estate industry. I'm David Greene, and this is Bigger Pockets Mortgage Monday. Boost in rate lock signals that buyers are back. Does it mean that people are stepping in to buy houses again? Well, it definitely could. Here's a pattern that I've noticed after about a decade selling houses. People tend to move in patterns. I call it the flock of birds theory. Have you ever been watching a flock of birds and noticed that they all move in the same direction at the same time? I remember as a little boy seeing that and just being amazed. How did the birds know when they were all supposed to be turning like that? It was incredible to me. Well, buyer patterns work the same way. The collective psychology of the market tends to all move in the same direction at the same time. How does this work practically in real estate? Well, when interest rates move, let's say they go up, the buyers tend to all back out of the market at the same time because of the shock of the higher rate. They want to wait and see if they're going to come back down. They wait a period of time, usually 6 to 8 weeks or so, and they collectively agree, well, I guess they're not coming back down, and they all jump back into the market at the same time. And I notice that this causes chaos every single time within the real estate industry because all the agents freak out and all the title and escrow officers freak out and all the loan officers freak out because everybody backed out of the market and the houses sit for a lot longer. I would take advantage of this by telling my clients that we're on the fence. Now's the time we want to jump in, because even though it seems like rates are higher and you might pay a little bit more for your rate, you're going to get a better deal on the price of the house, and that stays the same. Whatever you pay for it is what you paid for it. But if rates come down, we can refinance later. There's also no guarantee that they're going to come down. So it's one of the little dips that I would play when I was buying a lot of real estate or when I was representing clients that were helping them. And it's what I tell the people that are using the David Greene team or the one brokerage. This is one of the ways that we help you by advising you so you could save some money playing these dips. Well, if rate locks are up, that does mean that more people are in the market and they're afraid rates are going to go up more than they think they're going to go down. So let me know in the comments, have you read anything in the news or have you seen anything that makes you think rates are going to be going back up in the future? And to support that last article, mortgage application volumes rise for the first time in 3 weeks. If mortgage applications are up and rate locks are up, that means that there are more buyers getting into the buyer pool, which means in time, prices are going to be going up too. Here's something to think about. Price is always a function of supply and demand. It's fairly easy to recognize the amount of supply in the market at any given time. You just look at the listings that are on the MLS. Very easy to measure, but it was always difficult to track the level of demand. I couldn't see how many buyers were looking in a market at any given time. There's no rule that you have to register as a buyer looking at homes. You can track mortgage applications, but a lot of people apply for mortgage and they decide that they don't want to buy. Sometimes they're serious, sometimes they're not. Demand is very fickle. People can change their mind at a moment's notice. The right property comes along, the right life circumstance goes along. Think about when you bought a house. You probably didn't do it off of simply purely logical, practical things. Something changed in your life that made you want to. You went out there, you found the best house you could get, and that's the one you bought. Well, one of the ways that we try to measure buyer demand is by looking at rate locks and mortgage applications. So if those are both going up, it is a sign that demand is going up. And if demand is going up and supply is remaining the same, it's only a matter of time before prices increase. All right, moving on. Another article says that Rocket Mortgage rolls out AI-powered platform for underwriting. Now, this is interesting because as a business owner of a mortgage company, I have been worried about this for quite some time. And here's why. People have typically done jobs like this, where you have to collect information for lenders to help them decide how risky, how unrisky, how safe, or how profitable a different investment would be. A lot of people that trade in stocks, that do work like this, what they're doing is risk allocation. They're helping companies know where capital should be moved to or where capital should be allocated so that they can make decisions on where the most profit and the least risk would lie. Underwriting for residential real estate has typically been a combination of your debt to income ratio, your credit score, the loan to value, and your credit history. So lenders look at how responsible you've been with credit in the past, if you've ever had to be evicted or had a foreclosure, how much money you're making and how much debt you've taken on. They put all that together into a big formula, and a computer spits out a number that tells them how risky or unrisky you would be to give a mortgage mortgage to. And then to make it even more complicated, they say, okay, the riskier people are going to have to pay more. They're going to have more closing costs. They're going to have a higher interest rate to make up for the risk they're taking on. Well, if it's true that they're going to be using AI to do some of this and not people, that's a lot of jobs that are going to be lost. And this is coming at a time, and I've been saying this for a while, when there's already not as many jobs as people think. If you look at some of the unemployment numbers, they can be misleading because you might have lost your six-figure job as a software engineer and picked up a job for DoorDash. Well, technically, you're not unemployed, but you went from making $200,000 a year to $40,000, $50,000 a year. That's a reduction of 75% of what you were contributing to society, what you were pulling out, what you were being taxed on, and how much money that you were making. So even though you didn't lose a job from the market, you lost a quality job and replaced it with a crappier one. And I think that AI is going to be causing more and more of this. Now, what does that mean to you if you're reading this and you have a job? It means the same thing that I've been telling the underwriters for the one brokerage for a long time now. Your job is not to collect documents. Your job is not to input stuff into a computer and let it do the work. Your job is not to just submit loans in a portal. Your job is to look at the different options somebody has and walk them through that process with skill to help them decide on the best loan product for them. Your job is to go over a rate sheet and help them understand if they want to pay more to get a better rate or less to get some money back in closing. Your job is and always has been customer service. Now, when you're lazy, you sort of get away from customer service. You look to do the bare minimum at your work. And that's when you start cutting corners and you say, well, my job is to just get the loan submitted. Well, guess what? A lot of those jobs are going to be going away. AI starts eliminating the easiest jobs and it makes its way up the food chain, getting rid of everyone else. I'm wondering if we'll even have loan officers in the future where people are going to be applying for a loan entirely online without even talking to a human being. So once again, if you're someone who works in the real estate industry in some form of service, property management, loan officer, construction, real estate agent, title and escrow, design, you really need to be thinking about the relationships you have with your customers and the customer service you're providing, because that's one thing that AI can't take away. So let me know, have you seen a crazy headline related to mortgages or financing of real estate? Drop it in the comment. I want to see it. I want to react to it. And I want to give my opinion on what's going on because I want to keep you, the Bigger Pockets community, informed of what's going on in the market as well as financing real estate. If you'd like to know more about me, send me a DM on whatever social media you like the most. You can also send me an email on the Bigger Pockets website. And of course, you can check me out on the Bigger Pockets podcast. Subscribe wherever you listen to podcasts. That's all we've got for Mortgage Monday today. Make sure you subscribe to this channel. Leave me a comment on any crazy mortgage related news that you've seen. And if you've got a second, check out another video. If not, we'll see you next week on Mortgage Monday.